Most fiduciaries are costing their clients thousands in unnecessary tax. In this episode, I'm going to address how some retirees have saved $100,000 to $1.2 million in unnecessary tax. Get ready, you may want to save some unnecessary tax. So my name's Doug Andrew, and I've been a tax strategist now for more than 48 years, helping people usually prepare for long-term goals like retirement with the best solutions so that they can accumulate their money tax advantaged, even tax-free, and then be able to generate tax-free income for as long as they live. And when they ultimately pass away, whether that's age 70 or age 120, anything they leave behind will blossom in value and transfer income tax-free. Now, it's amazing to me how many financial advisors in America do not know how to optimize assets and minimize taxes. Many fiduciaries are actually costing their clients unnecessary tax. So get ready, I'll explain why and what you can do, and I'll give you some stories and examples to prove my point. So, as a retirement planning specialist, I've noticed that many people approach retirement, and I usually would have many attendees at my educational events come at least 5 years before retirement, because at retirement planning, is something totally different than maybe what you did for retirement planning. You'll understand what I mean here in just a moment. Many people will accumulate money in up to 4 different buckets, is what I call them, okay? And they will take income out of up to 4 different buckets. So let's define these. The investment income from their investments. Some people like real estate, they own rental properties or what have you. Others have guaranteed income, your Social Security, or maybe your school teacher pension, police officer, firefighter, they have different pensions and what have you. This is the most underutilized, but my favorite, and it's the tax-free income. And it's amazing how many people do not understand how to do this one. Okay, so let's talk about the buckets. First of all, up here, in the northwest quadrant of these is this purple bucket is what I call it. It's the investment bucket. I found that many people, when they would come to me at or close to retiring, they would be way too top heavy with money in this bucket. This is money in yet to be taxed. IRAs and 401ks is where 91% of Americans had their money, usually invested in the market. And I would look at them and go, what are you thinking? They were way too top heavy. And I would say, do you know that Wall Street was never really built to create predictable income in retirement? If you ask Wall Street, when is the best time to start selling my mutual fund shares or my stocks? They will say, never. They want you to grow your money and never sell. If you want predictable income, they don't know how to do that. In fact, most brokerage firms are restricted to only show you a 4% payout because the average retiree is only earning about 3.5% with their money in the market because they're buying and selling at the wrong times. And so they don't want to be sued for you outliving your money, so they tell their advisors to only show you a 4% payout, which is pretty pathetic. That means every $1 million will only generate $40,000 a year of income, and you have to pay tax on that. That's pretty pathetic. In fact, that's unacceptable to me. So the purple bucket, I find people have way too much money in there. I would recommend no more than 30% of your money at retirement be in this purple bucket. Many people, once they learn, they take 100% out. It's up to you, but I would say no more than 30%. Now, the other bucket over here is the blue one. Some people just own their home, which is fine. Other people, they might have rental properties, single resident rental homes, duplexes, apartments, maybe commercial properties, whatever. What I have found is this: a lot of people, when they approach retirement, they're sort of sick and tired of being a landlord. Taking out the trash and fixing toilets and evicting the tenants and so forth, but they're stuck because they've been doing 1031 exchanges. They've been continuing to postpone, thinking they're saving tax, and they want to avoid having to pay tax if they sell the properties and have to pay a long-term capital gain tax. And so they've been putting it off because tax law says, okay, if you continue to do 1031 exchanges, meaning you sell a property and you buy another like property for equal or greater value, you don't have to pay the capital gain tax. And the laws have basically said, if you die and you leave behind those properties, your kids will get a step up in basis. Meaning, if you bought a rental home for $250,000 30 years ago and it's now worth $1 million and you die, your kids don't have to pay a capital gain on that huge increase, except for what they sell it for over and above what it was worth when they inherited it. If it was worth $1 million and a year later they sold it for $1.1 million, they only have to pay a capital gain tax on the last 100,000. Well, we have tax revenuers. As of the recording of this episode, the Biden administration has been entertaining doing away with the step-up in basis on long-term capital gains. Whether they'll do that or not, we'll yet to see, but he wants to increase the tax. Many times taxes on long-term capital gains have been at a lower rate because a lot of the increase in the value of properties is just inflation. And so you're really being taxed unfairly, in my opinion. You're being taxed for inflation. Well, tax revenuers, many times they say, no, we want capital gains to be taxed on a full ordinary income or somewhere higher. And that's where it sounds like the Biden administration's going with capital gain taxes. But see, people get trapped and they're tired of being a landlord, and if they hire a property manager, I've heard horror stories of how many of them have embezzled money and so forth. But a lot of people think that this is the cat's meow. But I'm amazed how many people are actually sort of miserable and they wish they didn't have to be a landlord anymore. They're amazed when I show them how to get money out of here and even pay the capital gain tax and take the net and put it into my favorite account, which is this green one down here. And they're like, wait a minute, this is as much or more income as I was getting out of my real estate, and I don't have to be a landlord anymore? They're like shocked. They go, where have you been? I said, I've been here all along. You've had blinders on thinking that your real estate is the retirement nest egg. But whatever it is, I would recommend no more than 30% of your assets or your income be in this bucket when you retire, if you want to keep being a landlord. Down here, this orange bucket I've mentioned could be Social Security income. It could be a defined benefit pension like a school teacher, a firefighter, or a police officer. You can have this if you don't have any of those. There are a few annuities. There's only about 2 annuities out there I would even consider. I've never owned an annuity. I doubt I ever will. But an annuity allows you to accumulate your money tax deferred, but when you start taking income, it's now taxable, LIFO, just like an IRA or 401k. It's really not the best, in my opinion, when you have this option over here, the green bucket. But I would recommend between 0 up to, if you're super risk adverse, maybe up to 80% could come out of this orange bucket. Okay. This is my favorite, as I've said. Now, there are Roths and there are municipal bonds. Frankly, those aren't as popular anymore. Municipalities are filing bankruptcy left and right, and they're low yielding. Roths, I've never owned an IRA or 401k, and I never will, but I've never owned a Roth IRA or 401k, never will, and I'll show you why here in just a moment. My favorite vehicle I call the Laser Fund, and I've actually written a book called The Laser Fund. If you stay with me to the end of this episode, I'm going to show you how you can get a free copy. You can claim your free copy of this 300-page book. In fact, before I explain this green bucket, if this is already intriguing you, I would strongly recommend you share this video, post a comment, click like, but subscribe to the 3Dimensional Wealth channel. Why? Because I post an in-depth answer to a financial question almost on a daily basis. And it's free. And at the end of this episode, I'm going to show you how you can claim your free copy of this 300-page book. But I'm passionate about giving you insights into opportunities that maybe you didn't know existed before. Are you ready to learn about the green bucket? Okay, so when we look at this one, this allows you to be able to accumulate money tax-free and be able to generate tax-free income. So one of the strategies you'll learn about in the Laser Fund book is how to do a strategic rollout. This is not a rollover. A rollover is like going from the frying pan to the fire. This would be taking money out of a 401k and rolling it over to an IRA and continuing to delay, postpone, procrastinate paying tax until you're age 72, and then what happens at age 72? You're required to start taking out at least a minimum distribution. These are called RMDs, required minimum distributions. In fact, if you don't start taking money out of an IRA or 401k by age 72 based upon your life expectancy, the government, the IRS, will penalize you 50% on top of the tax. If you have $1 million and your life expectancy is 20 years, you have to take out 1/20th at age 72. If you don't take out that 50 grand, the penalty is 25,000 on top of the tax on the 50. The government wants that money out and taxed, and they'll tax it again when you die, but see, they've been counting on that tax revenue. So what's better? Instead of postponing and delaying, many people go, it's going to be better to pay taxes now. In today's lower rates, get the taxes over and done with sooner than later, and roll out the net after tax into this green bucket and have it be tax-free the rest of my life. And when I finally die, whatever's in here will blossom and reimburse my spouse, my kids, and grandkids with any of the tax I did pay when I got it out of the purple bucket. If this is like, whoa, wait a minute, I need to learn more, yeah, you can read about it in the book. So, I told you I would share a few examples. I have a story in the book about a husband and wife. They're both school teachers. When they came to me at age 60, their advisor was telling them to postpone until they were age 70 and a half. Back then, you had to start taking it out at age 70 and a half. They were going to pay $250,000 of unnecessary tax if they took that advice and postponed and took out RMDs, required minimum distributions. They were flabbergasted. They only had $250,000. And yet they would end up, by stringing it out, paying $250,000 or more in unnecessary tax. We got their money out in 5 years. We actually eliminated the tax. We saved them $250,000 of tax, and they were able to generate twice the income that their 401ks, their 403bs, and their tax sheltered annuities would have generated. They were able to do all kinds of things for their children and grandchildren they would not have been able to do had they left their money in 403bs and 401ks. Read the story. I had a real estate landlord. His wife passed away. He came, and when he saw what we could do, in 5 years, we saved him $750,000 of unnecessary tax. We do this all the time. He is so grateful. He now has 4 times the income than his advisor was showing him he could get out of his 401ks. We had a husband and wife, both physicians, and they had accumulated $4.6 million. And their advisor said, well, yeah, they're going to have to pay a lot in taxes, but they can afford to pay $2.6 million in tax, because I calculated they would pay $2.6 million in tax out to their life expectancies following the herd, doing RMDs and what have you. Well, I said, well, let's ask them. I said, I think I could save you $1.2 million. I can't save you all $2.6. Would you like to save that? They go, hello, yes. We saved them $1.2 million of unnecessary tax. That is funding what I call a family bank. They can use it, but it's generating $100,000 a year of tax-free income. And they don't even need that, but it's benefiting their children and grandchildren with all kinds of college funding, working capital for their grandkids' business endeavors, humanitarian, military, religious missions, all kinds of things, instead of it going down the drain in unnecessary tax. One last example. We took a California couple from the highest tax bracket to a 0% tax bracket. You remember I said I recommend 40 to 60% of your income not even show up on your 1040 tax return. They wanted 100% of their income. After paying tax in 5 years, we ended up with $4 million after tax that has now in 7 years doubled to $8 million. Now, they've been averaging over 10%. $8 million has been generating $600,000 to $800,000 a year of tax-free income. The IRS knows they're receiving it, but it's tax-free. They only need $300,000 to live on, so their account has been growing at $500,000 faster than they need money. Does that make sense? You can read about these stories. The point is this: when I've had people come and they thump themselves on the chest at retirement and they say, Doug, we're going to get about $40,000 from Social Security or maybe my wife's school teacher pension, what have you, but $160,000 is going to come out of this portfolio of $2.6 million in IRAs or 401ks. And I go, well, okay, way to go. One problem, it's all showing up on the front page of your 1040 tax return. And they go, you mean there's a better way? I go, yes. See, you're going to pay $54,000 in tax every single year or more the rest of your life. You're only netting $146,000 to buy gas, groceries, prescriptions, and golf green fees. With inflation, pretty soon you're going to need $400 to buy what $200 used to buy. What we did in 5 years is we got $120,000 of that $200,000 off of their 1040 tax return. They still have the same $200,000 of income. The IRS knows they're getting that other $120,000, but it's a no-brainer. It's tax-free. They only pay $21,000 in tax now. They're netting $178,000 more money, and we save them $32,400 a year. If they live out to life expectancy, that's $810,000. We've saved many people that much or more. We've saved many couples over $1 million of unnecessary tax with one strategy, a strategic rollout. So if this is intriguing you and you want to learn, I would strongly recommend you look at doing a strategic rollout, which is not a rollover. So if you want to learn more about what a strategic rollout is, it's explained not only in the white covered side of this book, 200 pages with all the charts and graphs, but there are stories like the ones I just shared with you on this side. Just simply go to laserfund.com, L-A-S-E-R fund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that. I'll pay for the book. And you can learn how you can do this, how to prevent it, or how to cure the tax dis-ease. Because when you're not at ease financially, okay, it's like a real physical disease. And what causes most people to outlive their money is unnecessary tax. By reading and studying your copy of the Laser Fund, you'll gain insights into how you can save $250,000, $500,000, maybe over $1 million of unnecessary tax. Claim your free copy now, and here is to your brighter future.